Hello and welcome to this session on financial instruments. In a financial system, there is a wide range of financial products that are offered. They include stocks, bonds, foreign exchange, derivatives, commodities, and money market instruments. Now, in this session, you will learn about the two main types of financial products, such as stocks and its two subtypes, common stocks and preference stocks, and debt instruments, under which you have bonds and its types. First, let us start with equity. What exactly is equity? And what is the difference between equity, stock, and shares? Equity is a share in the ownership of a company. It represents a claim on the company's assets and earnings. Whether you say shares, equity, or stock, it all means the same thing. As you acquire more stock, your ownership stake in the company becomes greater. Equity is nothing but ordinary shares or stock in a company that represents ownership. They are also known as common stock or ordinary shares. Now, for example, company XYZ has floated 1000 shares. Mr. A holds 300 shares of a company. This makes Mr. A 30% owner in company XYZ. Now, why do you need equity? Raising funds through equity is one of the most common methods of raising long-term funds. Generally, there are two types of equity shares: preference and ordinary. We will talk about preference shares in more detail in the next modules. Preference shares carry preferential rights regarding the payment of dividends, meaning before the common stockholders, preference shareholders will be paid their dividend. Also, the preference shares carry a fixed rate of dividend. Repayment of capital is also preferential in nature during winding up of the company. Directors, however, may decide not to pay any dividend to any class of shareholders, even if there are sufficient profits, but its dividend is paid before the dividend of ordinary shares. Moving on to debt instruments. Debt is the amount borrowed from the investor under specified terms and conditions. Think of a loan taken from a bank. That's a debt instrument. A debt arrangement gives the borrowing party permission to borrow money under the condition that it is to be paid back at a later date. After the maturity of the period, these borrowed funds are paid back with interest. Bonds are a debt instrument issued for a period of more than 1 year with the purpose of raising capital by borrowing. In the example on screen, Company X has issued a bond to a buyer who pays cash in return. On maturity of the bond, the company will pay the buyer both original amount along with interest. Depending on the duration, a bond can be classified into short-term bonds of 5 years or less, medium-term bonds of 5 to 15 years, and long-term bonds of 15 years or more. Now, bonds are a way to finance the operations of a company. Sellers include the federal government, states, cities, corporations, and many other types of institutions sell bonds. Major issuers of bonds are governments. Some examples include treasure bonds in US, gilts in the UK, and bunds in Germany. Coming to types of bonds, we have two types: secured and unsecured. Secured bonds are guaranteed against the assets of the company that issues them, and usually the asset is debentures. Since there is collateral, secured bonds are safer. Then you also have unsecured bonds. Unsecured loans are not secured against the assets of the issuer. They are normally compensated for a higher rate of interest payment, but are also more risky. The types of bonds available in the market are corporate bonds, government bonds, zero coupon bonds, convertible bonds, inflation indexed bonds, junk bonds, callable bonds, putable bonds, perpetual bonds, deferred bonds, sovereign bonds, and foreign currency bonds. Each of these bonds will be further explained in consecutive sessions. This completes the first section on financial products. The other products will be covered in the next section. Thank you for your time and goodbye.